Welcome to Living Your Wealth Today and Tomorrow, the show where we explore how to enjoy the wealth you've already built, as well as how to best plan for a successful financial future. I'm your host, Kelly Ennis, founder and president of Infinity Financial Strategies. Welcome back to Living Your Wealth Today and Tomorrow. I'm your host, Kelly Ennis, financial advisor and guide to making sense of what matters most in your financial life. Today, we're diving into one of the most famous, and sometimes misunderstood, ideas in retirement planning, the 4% rule. But let me start with this. The 4% rule does not apply to everyone. It's a helpful framework, a starting point, a rule of thumb. But like all rules of thumb, it leaves out nuance, context, and most importantly, your individual situation. So, over the next 20 minutes, we're going to cover where the 4% rule came from, what it really assumes, where it works, where it doesn't, and how modern approaches like buckets, guardrails, and inflation protection can give you more flexibility and peace of mind in retirement. Let's start with the origins of the 4% rule. The story begins in the early 1990s with a financial planner named Bill Bengen. In 1994, Bengen published a groundbreaking study in the Journal of Financial Planning. His goal? To answer a simple but critical question. How much can a retiree safely withdraw from their investment portfolio each year without running out of money? He tested different withdrawal rates against historical market returns going back to the 1920s. He assumed a balanced portfolio, 60% stocks and 40% bonds, and a 30-year retirement horizon. The conclusion was eye-opening. No matter what 30-year period you tested, even including the Great Depression and the stagflation of the 1970s, if you withdrew 4% of your initial portfolio in year one and adjusted that dollar amount for inflation each year thereafter, your money lasted at least 30 years. This became known as the safe withdrawal rate. Later, in 1998, three professors, Philip Cooley, Carl Hubbard, and Daniel Waltz, expanded on Bengen's work with what became known as the Trinity Study. They ran thousands of scenarios across different stock-bond mixes and withdrawal rates and published the probabilities of success based on their findings. And this made the 4% rule gain even more traction. Now it's been referenced in countless financial planning articles, books, and even TV shows ever since. But, and this is critical, the assumptions behind the rule are very specific, and not everyone's retirement looks like those assumptions. So let's talk a bit about the assumptions built into the 4% rule, and where it may not fit your life. The 60-40 portfolio assumption. Bengen's model used a 60% stock, 40% bond portfolio. That mix is meant to balance growth and stability. But if you have other sources of guaranteed income, like Social Security, a pension, or an annuity, you might not need such a conservative portfolio. A more growth-oriented mix could support higher withdrawals over time. Here's a practical example. If you retire with $1 million portfolio, the 4% rule says that you can safely withdraw $40,000 in your first year. That withdrawal typically comes partly from dividends and interest and partly from selling investments. In other words, you're dipping into your principal. But you could also structure your $1 million portfolio to generate roughly $40,000 in current income through dividends, interest, and distributions without touching the principal. That's the difference between a total return withdrawal approach, what the 4% rule assumes, and an income-first approach, what some retirees prefer. Both can work, but they feel very different in practice. One of the biggest blind spots in the 4% rule is the sequence of returns risk. If the market drops heavily in the early years of your retirement and you're withdrawing at a steady rate, you're pulling money out while your account is down, locking in losses. That's sequence of returns risk. But the reverse is also true. If you retire into a strong bull market, you may end up limiting your spending unnecessarily. Consider Susan, who retires with $1 million in 1990. She follows the 4% rule, $40,000 in year one, adjusted each year for inflation. But the 1990s were one of the strongest decades in market history. After 30 years, instead of her account dwindling to zero, she has nearly $2 million left. She spent her retirement being cautious, but ended up with more wealth than when she started. On the other hand, consider Janice, who retired on November 1st, 2007, with $1 million in her portfolio. Over the next year, her portfolio drops by 20% to $800,000 even before withdrawals. Now, two things to think about. When she withdraws money from her portfolio, the dollars she withdraws never get a chance to recover. And think about the time and rate of return necessary just to get back to where she started. To get back from $800,000 to $1 million requires a 25% return because you'd be starting with a smaller base. You'd need a higher rate of return just to recover the 20% loss. Then there's the time it takes to recover. This is time during which we projected growth from the original starting point, but it's essentially lost time because we're just trying to get back to where we started. Sequence of returns risk is most dangerous early in your retirement. If your portfolio has already grown, especially if it's grown at a higher rate than the inflation rate, you probably have more flexibility and resilience because you've built more of a buffer between the size of your portfolio and the amount of your spending. And remember that Bengen's research did show that portfolios survived at least 30 years with a 60-40 investment mix in all years tested. The question is, how confident you'll feel about that study if your portfolio starts to dwindle. At some point, you may question whether the calculation of your withdrawal amount, which does not take the market downturn into consideration, is really valid. Another factor to consider is the 30-year time horizon. The original study assumed you retire at 65 and live to 95. But what if you retire at 55 or even 50? Suddenly, you're looking at a 40 or 45-year horizon. That changes the math. The study didn't consider other time horizons, so there is the question of what circumstances might lead to portfolio depletion by year 35, 40, or 45, and what withdrawal rate or investment mix might have produced reliable success for those other time horizons. Here's an example with early retirement. John retires at 55 with $1.5 million. If he follows the 4% rule, he starts with $60,000 per year. But his horizon isn't 30 years, it's more like 40. The risk of outliving his money is higher. In this case, a safer starting rate might be closer to 3.25%, around $48,750. That's a big difference in lifestyle planning. And there's also the concern about longevity in the case of health issues and medical conditions. Unfortunately, many retirees are living with medical conditions that can diminish their quality of life, possibly in conjunction with a lower life expectancy. Here's where this becomes a challenge. If you have a condition that results in a reduced life expectancy, do you spend faster and enjoy your wealth while you can? Or do you still anticipate the standard life expectancy because there are new medical advances every day? And keep in mind, even without this complicating factor, there's nothing to say that a healthy 65-year-old retiree won't be alive at 100 years old other than statistics. But those statistics don't say everyone will be gone at 95. They just say that it's more likely than not that any given individual will pass away by age 95. The data doesn't say that there's a 0% chance of being alive after 95 years old. Are you comfortable with the thought of still being with us at age 98 but out of money? In my mind, the biggest weakness of the 4% rule is that it's only about portfolio preservation. The 4% rule doesn't consider tax efficiency. It doesn't tell you whether to pull from your Roth IRA first, your taxable brokerage, or your 401k. It's completely silent on issues like required minimum distributions, capital gains rates versus ordinary income tax rates, or Medicare IRMA brackets. It's not about efficiency. It's only about survival. Again, it isn't a plan. It's a rough guide. So here's an example of how vastly different the outcome can be in a single year using only the 4% rule, being in survival mode, as opposed to planning to thrive. Let's say you retire at 60 years old with $2 million in your pre-tax 401k. The 4% rule says you can take $80,000 from your portfolio in the first year. And this is the base, From here on out, you'll adjust the $80,000 for inflation each year. Let's also say you get a small pension from a previous employer that will amount to about $6,000 a year. And let's say you get about $1,750 in interest on your liquid emergency fund that we don't consider as part of your portfolio. Now, here's where you'll see the difference between using just a guideline and having a plan. You'll withdraw $80,000 from your 401k, which is invested in a 60-40 balanced fund, and you'll have your pension and your interest for a total of $87,750. After taxes, you'll be left with $76,996, and that doesn't count state taxes. You will have depleted your portfolio by $80,000. Now, let's change that up and see the results of a plan that is tailored to a specific set of circumstances. The portfolio is split between pre-tax retirement accounts, taxable investment accounts, and Roth accounts. To draw the $80,000 from the portfolio, you take a mix of qualified dividends and long-term capital gains from your taxable brokerage account. You take some money from your Roth IRA, and you take some cash from your short-term investment bucket. You also have your small pension and the interest just like above. All in all, after taxes, you'll have $85,565 of the $87,750 that you had for income. You will have depleted your portfolio by $50,000 rather than $80,000 because you're meeting part of that withdrawal by dividends produced by the portfolio. The difference between those spending amounts, $85,000 versus $76,000, is significant enough to make a difference in your lifestyle for that year. If we use larger numbers, first, most of my listeners are driving and I want them to focus on the road. But second, the situation only gets more complex. There are additional taxes, fees, and surcharges that apply on higher income levels that can be avoided with proper planning. The 4% rule only addresses portfolio depletion. It doesn't consider ways to deplete the portfolio at a slower pace. The first example, the full withdrawal from the pre-tax 401k, illustrates the challenge of having a large pre-tax 401k balance. You can listen to episode 3, The Challenges of Being a 401k Millionaire, to learn even more about that. So yes, the 4% rule is useful as a guideline, but it's also vague. It's like saying you want to go to the United States and you're picturing Boston, but you could also end up in Hawaii. Let's take a look at some more modern approaches to your portfolio and retirement. Financial planning has evolved since the 1990s. Today, we recognize that retirees want more than just survival. They want flexibility, peace of mind, and the ability to enjoy life without fear of running out of money. That's where strategies like the buckets approach and the guardrails approach come in. First, the buckets approach. With this approach, you think of your retirement portfolio as a series of buckets, each designed for a different time horizon. Bucket 1 is for short-term cash needs. It covers the next 1 to 3 years of expenses. It's kept in cash or very safe instruments, and the goal here is stability, so you're never forced to sell stocks in a down market just to cover living expenses. Even if the market experiences a serious downturn, you know that you can cover your living expenses from your cash bucket, giving the dollars invested in the market time to recover. Bucket 2 is for intermediate needs and usually covers years 3 to around 10. It's typically invested in conservative balanced funds. The goal here is just modest growth with limited volatility. And bucket 3 is for long-term growth. This is your stock bucket. This isn't money you need today or even this decade. This is the engine that keeps your portfolio growing over a 20, 30, or 40-year retirement. The idea is that when the market drops, you're drawing from buckets 1 and 2, while bucket 3 recovers. When markets are up, you refill the short-term buckets from bucket 3 by selling investments that have grown. It's a psychological framework that can help you feel confident that you'll be okay, even when markets decline. And it's a practical framework that can help minimize the effects of withdrawals when each withdrawal becomes a larger percentage of your portfolio due to the market downturn. It works by setting up your portfolio so that you're not withdrawing from the segment of your portfolio that experienced the downturn. There's also the guardrails approach. Now, the guardrails approach is about setting rules that adjust your withdrawals based on portfolio performance. Here's how it works. You start with a target withdrawal rate, let's say 4%. If markets do well and your portfolio grows beyond expectations, you give yourself a raise. Maybe you increase your portfolio spending to 4.5% or 5%. If markets struggle and your portfolio shrinks, you tighten the belt slightly. Maybe reduce portfolio spending to 3.5%. Let's look at a quick study of a retiree with guardrails. Mary starts retirement with $1 million in her portfolio. She withdraws $40,000 in year 1. By year 5, her portfolio has grown to $1.3 million thanks to strong markets. The guardrails approach says, congratulations, you can bump your spending to $50,000 a year. Fast forward a few years, markets dip, and her portfolio falls back to $950,000. Now the rule kicks in again. Cut back to $35,000 in portfolio spending until the portfolio recovers. Mary isn't locked into one path. She spends more when times are good, and she tightens when necessary. This is like bumpers in a bowling alley. You're aiming straight down the middle of the lane, but sometimes things go off course. The lane is your portfolio. The bumpers are the guardrails. Your portfolio withdrawals are the path of the ball down the lane. The bumpers or guardrails are there to keep your portfolio spending within reasonable limits based on where your portfolio is at a given time, rather than picking a number at the beginning of retirement and only adjusting it for inflation. In our firm, we use buckets and guardrails together. We segment portfolios into buckets, not only for retirees, but also for investors who are still accumulating, but have financial goals which involve the funds in their portfolios. The guardrails come into play primarily during the work optional years when ongoing portfolio withdrawals are likely. And now let's talk about something that keeps so many retirees awake at night. Inflation. When Bill Bengen did his original study, inflation was baked into the model. Remember, the 4% rule assumes you increase your withdrawals every year to keep pace with the consumer price index. But inflation is not always predictable. We just lived through 2021 and 2022 when inflation spiked to levels not seen in 40 years. For retirees, and really everyone else, that meant groceries, gas, healthcare, everything got more expensive very quickly. If you were withdrawing $40,000 a year, and suddenly you might need $44,000 or $46,000, 10 to 15% more, just to maintain the same standard of living, that's a big jump. So here's an example of inflation shock. Tom and Linda retire in 2020 with $1.2 million. They start at $48,000 a year, but by 2022, inflation hits 8%. Their inflation-adjusted withdrawal jumps to $51,800. On paper, that's fine. The 4% rule allows for inflation adjustments. But if markets are down at the same time, as they were in 2022, they're now pulling more money from a portfolio that's already shrinking. This double hit, higher withdrawals plus market losses, is one of the biggest threats to retirement sustainability. And here's another wrinkle. While the 4% rule uses CPI, retirees often experience personal inflation rates that are higher than CPI. Why? Because healthcare, which makes up a larger portion of retiree spending, tends to rise faster than the overall CPI. So, if healthcare costs are climbing at 5 or 6% per year, while the CPI is averaging 2 to 3%, your real cost of living in retirement may feel much steeper than the official numbers suggest. So, how do you protect yourself from this inflation threat? First, diversify your sources of income. Social Security is inflation adjusted. Some pensions have cost of living adjustments. Having guaranteed, inflation-protected income helps. Rental income can also help. But keep in mind that those at the beginning of retirement may not have access to Social Security yet, and pensions are few and far between these days. Then, consider inflation-sensitive assets. Treasury inflation-protected securities, or TIPS, real estate, and even stocks can provide long-term inflation hedges. And stay flexible. This is where guardrails can help. Maybe in high inflation years, you don't give yourself the full raise on withdrawals from your portfolio. You pull back slightly to protect it. Inflation reminds us of the same theme. Rules of thumb are a starting point, but flexibility is the key to long-term success. So what does this mean for you? If you're using the 4% rule, know what's behind it. It's a survival test, not a lifestyle plan. If you have guaranteed income, you may not need to be as conservative with your portfolio. If you retire early, plan for a longer horizon and a lower withdrawal rate. Consider strategies like buckets and guardrails to give yourself flexibility and confidence. And always remember inflation, because the dollar you withdraw in year 15 won't buy as much as it does in year 1. And above all, remember that your portfolio is just one piece of the retirement puzzle. Taxes, healthcare, lifestyle choices, family goals, and even charitable giving, they all matter. A rule of thumb is a starting point, not a finish line. The 4% rule changed the way we think about retirement planning. It gave people a benchmark, a sense of direction, and a way to frame one of the scariest questions in finance. Will I run out of money? But today, we have better tools. We can go beyond rules of thumb and craft personalized strategies that reflect your real life, your goals, and your flexibility. As you think about your own retirement, ask yourself, do I want to follow a rule or do I want a plan? Thanks for joining me today on Living Your Wealth Today and Tomorrow. If you found this episode helpful, share it with a friend or leave a review. And remember, wealth isn't just about money. It's about creating the life you want to live today and tomorrow. Thanks for listening to this episode of Living Your Wealth Today and Tomorrow. This podcast is for educational and informational purposes only. It is not tax, legal, or investment advice. Seek guidance from your legal and financial professionals before acting. For more insights on planning for your financial future, follow me on LinkedIn. And for more information on Infinity Financial Strategies, visit our website at infinityfinancialstrategies.net. If you enjoyed the show, please share it with a friend or family member who might benefit from listening, and please leave a review wherever you listen. Tune in next time for more tips and tricks on living your best life through financial planning.